So guys, I'm going to show you 6 reasons why you're not making money trading Forex. Strategy chasing. So many traders keep chopping and changing their trading strategy rather than giving it time to pan out. This is one of the biggest problems I see traders chasing the holy grail and hoping that they're going to get a winning strategy. All strategies need to be developed around the individual, their personality, and also their availability to be able to build consistency. If that strategy doesn't meet your personality and it also doesn't meet the times that you're available to be able to trade, whether it's short term or long term, so you need to be able to break that strategy down to be able to adapt it to fit your criteria of what works for you. But too many people are chasing the holy grail and keep chopping and changing the strategy. If you do that, you will never be profitable. And that is something that we're seeing more and more of all the time, is individuals chopping and changing their strategy. So the second reason is patience and discipline. Consistency is what you need when you're getting started. The reason why this is so important is it's just like your job, your work. You need to treat trading as a business, which means that you need to get to your charts at the same time each day and finish trading at the same time each day. What this does is it increases your chance of probability to see how your trading strategy performs. If you're turning up at different times, different trading sessions, then you're not going to get the same probability outcome. So what do I mean by that? If you're trading in the morning, you're obviously trading European and UK sessions. If you're trading in the afternoon, you're trading the US sessions. Now, if you trade one morning, one day, the afternoon, the next day, you're turning up to your charts at different times and there's different players in the market, different trading zones are in play. This will heavily affect your probability and your outcome of your strategy, and it's important to get started with basic consistency. Number 2, the Dunning-Kruger effect. So when traders get a taste of making profits in the very early stage of their career, or should we say retail trading, if they're not using a strategy or they're chopping and changing it, they think that they've hit the holy grail. This actually relates to what we call the Dunning-Kruger effect, which is a cognitive bias, and this will affect you both at the start of your career and also when you're at your professional level. Now, how does it affect you at both extremes? So once you get started, you'll get off to a good win rate. Usually happens, it's called beginner's luck. Now, when you see that, you think that you're super experienced and that you've got the knack to be able to do this at a professional scale. Now, what does this mean based on this theory known as the Dunning-Kruger effect? It means that the individual has limited competence in the skill set that they're applying. They overestimate their ability and then they start making mistakes and they end up losing money. The more knowledge that you attain and the more that you understand the markets, the less that this will affect you. And it also affects you when you're at your professional level after attaining vast amounts of information, like myself, 10 years plus trading experience, where I have a high competency in the markets and this skill set, and I understand a vast amount of information of how the markets work. But at the same time, I could underestimate my skill set and that could also affect my trading. So it's something that you need to be careful of at the start of your career and also when you're at that professional level. The third point is no education. If you have no education, you're basically flying blind in the markets. You don't know what you're looking for. You're getting this whole effect of the Dunning-Kruger, and that is coming into effect in the marketplace that you're trading. And ultimately, it's going to give you false hope within the markets. You don't really understand what you're doing and you don't really understand why you are winning. And there is that famous saying in the markets that with education, you're either going to pay through your losses in the market or you're going to pay through professional training. So with education, where can you start? We have multiple courses on our website that you can look at, all the way up to off-qual regulated level 5 and level 7 diplomas, which teach you how to trade up to a master's degree level. This will help you cover with the theory, but ultimately you're still going to need to apply this theory to the markets. Having an education is key. There is no point turning up to trade if you don't have any theory-based understanding of simple dynamics around the markets, such as monetary policy, fiscal policy, fundamental analysis, technical analysis, economic indicators. These are all factors that you need to take and put at play within the markets. And if you don't understand that, now is the time to start building up that educational base before you start risking your hard-earned money in the markets. The fourth reason is setting unrealistic expectations. So many people go into trading and assume they're going to make a vast amount of money very quickly. This is not the case. Now, how do we combat this? We need to be able to set realistic goals. Set yourself 12 months. You've got to think of this in a realistic manner. When you learn any new skill set, how long does it take to become competent at utilizing that skill set? Arguably 3 months, 6 months, 12 months are all reasonable goals to set depending on your level of competency currently in trading. I remember when I set my first goals when I started to trade, it was within 6 months be break even. Can I hold on to the money that I started with? And hitting a break even point is probably one of the most crucial parts of your trading journey, because it means that you're just on the horizon to being profitable. I want you to write down and journal your 3-month goal, 6-month goal, and 12-month goal, and keep them realistic. If you're going into this to expect to flip money, make a vast amount of money within your first month, you're going to completely fall on your face and become part of the statistic of 70% plus of retail traders lose money in the markets. Don't become that statistic. Start planning on how you can achieve your goals in a realistic manner. So reason number 5 is risk management. So many traders are blowing their account due to poor risk management. Now, I'm not going to go into this too much in detail, and the reason why is I've already discussed this in my previous video here. It's definitely worth checking out because I go into depth why it's so important to have a positive reward to risk. Traders typically targeting a 2-to-1 reward to risk or 3-to-1 reward to risk. We also want to make sure that we're risking just 1% or less of our trading account size. Why is this important? It allows for you to have multiple losses following your strategy in a row without damaging your account to a degree of where you cannot bring it back to profitability. More importantly, start practicing on a demo. Implement your trading strategy and make sure that you're competent and comfortable using that strategy when it comes to live funds. We need to make sure that we're maintaining a profitable reward to risk, allowing us to win less trades in our strategy. You know, if we have a 3-to-1 reward to risk, we can be profitable winning just 40% of our trades. Having low leverage is also very important. It stops us from damaging our account too much whilst being able to maintain our strict risk management protocol that we want to implement on our trading account. So the 6th and final point is the trader's mindset. At Samuel Co, we're blessed because we have a trading mindset coach. But I'm going to give you some of the crucial points here around your trader's mindset. Having your mindset first is what is the most crucial part. You are the individual that are placing the trades on your account. Now, it sounds very silly to say this, but how you wake up in the morning, whether you're in a bad mood, a good mood, an anxious mood, this all affects how you're going to day trade in the markets. You need to make sure that your emotions are neutral to when you are placing your trade. If not, you're involving emotions in your trading decision and this never ends well. Now, this takes time to build up on the trader's mindset, and especially when you're risking actual capital within the financial markets, it will be an emotional roller coaster. And the best way that I have managed to overcome this is simply by writing the money off. Whatever I have put into my trading account, I don't need it to pay the bills at the end of the month. I don't need it to go out and socialize, and I don't need to withdraw it at the end of the month. By writing that money off, I'm in a much more neutral state of mind when I come to implementing my trading strategy. You need to be able to get to the point where whatever money you are using within the markets, you're comfortable losing. Don't have an expectation that you're going to make money. Just like any business that you set up, you have to have a certain period of time before you start making money. That could be 3 months or it could be 6 months. It could even be a year before you start making money in a business. It's exactly the same in trading. This will give you a true chance at becoming profitable within the markets. If you want to become a competent trader within the markets, then check out the link in the description. I have pinned, it is about our level 5 and level 7 diploma within the financial markets. You can earn an off-qual government regulated diploma that's the same level as a master's degree. If you want to become competent, that's one of the ways that you can do it. If not, make sure you thumbs up, comment and subscribe on this video, and I hope that you can take away some tips that are going to make you a better trader.